Welcome to the deal room.
Welcome.
Welcome.
Whoop, whoop.
Welcome, everybody. Thank you for tuning in today, liking and subscribing. Today, we have a very special guest with us, all the way out of Dallas, Texas. Without further ado.
Just in time for episode 10.
Yes. We'd like to welcome Mr. David Hills from Hills Financial Services. Nice round of applause for David. Woo 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 woo.
Well, thank you. I appreciate it, guys. I appreciate you being
David?
part of
Can you hear us okay?
your success story.
We appreciate you taking the time today, sir. We really do.
Thank you, sir. We appreciate it.
We all brothers from the other mother, so, hey, got to stick together.
Yeah, so a little backstory. Me and Dino met David how many years ago, would you say?
3, 4?
3-4 years ago? Dave, is that how long have we known you? About 3-4 years now?
It's been going on. It's almost 4 years, about almost 4 years.
Almost 4 years, okay.
Nice, yep.
And in that time, so everyone out there knows, David is a lender. And there's been times that David has had to help us in the clutches when me and Dino working on deals, as well as other agents that we work with on deals, that sometimes in the 11th hour, there's some hiccups that came up, and David has come through to save the day.
I think it's called a rug pull.
A rug pull. There we go, a little rug pull.
From other lenders, especially sometimes locally, you can't always depend on the local bank to get it done, and you got to call for reinforcements.
Yes.
Heavy artillery.
Bring in the big guns.
Right, David?
Yes, sir. You guys are number one.
Oh, we appreciate that. David, do you want to give a little background on you? Let the people know who you are that are tuning and listening, and not too long, because we have a short show, but a little background on yourself, sir.
Okay. I started off in the mortgage finance business back in the late 80s. I've worked both sides of the industry, residential, primary financing, and also working commercial / business purpose type loans, like fix and flips, rentals for 1 to 4 units, and also in the commercial space. I'm also a note broker, so I facilitate transactions with investors that are looking to either buy mortgage notes or looking to sell mortgage notes. And I do loans in 30 states throughout the United States and in 20 foreign countries. So I work with a lot of foreign nationals that are looking to buy real estate in the United States, help them establish themselves by creating their LLCs and tax ID number, help them open a bank account that gives them a presence here in this country in order to buy real estate for investments. And it also helps them to secure their green card through the EB-5 programs and other programs that immigration has. I have several business partners. One is an immigration attorney. The other one has his own insurance company. So we help cover investors in the full process of basically a one-stop shop. So that's the little background on me.
I love the way you're helping, bring other countries into our economy. That's like fantastic.
It's a skill.
And that's the American dream, right? Like that's what we're all about is.
It also helps other professionals such as yourself and Dino that they can expand their investor base by working with people that don't know the market that you're in and don't know how our real estate programs are done. So they're looking for opportunities, but they don't know where to look, or they don't have any idea how our country and our business, our real estate philosophy works. So bringing them into the country and letting them work with professionals such as yourself and Sean gives them opportunity to be educated and learn what the process is of buying real estate here, and also gives them opportunity to work, like I said, with professionals such as you and Sean.
Yeah, we appreciate you for that. Definitely.
Yeah.
Definitely. Do you want to go into some of the different, maybe the difference between a banker, like a local banker, and then a lender such as yourself?
Well, lenders such as banks and credit unions are institutional, are regulated by the government. They have to follow certain government guidelines and protocols and rules and regulations. And in the private sector, it's different. You know, you don't have the constraints and the regulations tied to you when you're doing financing for investors that are in certain situations. So it gives people such as myself more freedom and more creativity as far as how to structure deals and make deals work that benefits the investor as well as everybody around. Because as you know, you've had deals where you couldn't get lending on it, and you have to get creative and try to structure it where where everybody actually wins. The seller wins because he's selling his property. The buyer wins because he doesn't have to go through a lot of red tape and jumping hoops to make the deal work. And then such as yourself and Sean, you'll be able to make money without having to be tied up with the financial institutions' guidelines and timelines that it takes to get these deals done.
Excellent. Excellent. Do you have any insight on, like, let's say, I understand you spoke to it, but like if you were speaking to, let's say, uh, one of my buyers, for instance, like, hey, David, my banker, Mr. Mike McDonald or whatever, is giving me da 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 da, and what's the difference in what would you say to him? Like, why would you go to that bank when I can do what for you?
Well, the difference with me and a traditional lender is that I have access to multiple opportunities as far as loans. You know, there's all different type of loans programs. And so a person who claims or say they have a relationship with one particular institution, they do have a relationship, by doing the banking business services. But when it gets down to it, it's all about the property. So the property has to be something that a institution such as a credit union or bank want to put on their books or want to do the loan, because they're financially responsible for any loan that they write that doesn't produce. Because like credit unions have memberships. Well, memberships are like shareholders. You have to account for the losses of revenue when it comes to properties that are being foreclosed on. Same thing with banks. Banks have shareholders and stockholders in their company. And so they have to, again, answer to those individuals wondering, why did you write a loan for a property that was not a good loan? And you can't go around writing bad loans and expect to keep your job or to be a profitable institution. Banks have goals or projections that they have to meet yearly. They have to grow their customer base by adding more customers. That's the reason why they're always advertising about checking the savings programs. We have loans here at this rate. They give you teaser rates in order to get you to come in to make inquiries to do a loan. So that's how they're different versus me that has multiple access to funding, and my relationships are stronger because I know what they're looking for, which means I can tell an investor, this is not a good deal because this deal's not going to go through. And this is what this particular investor is looking to do to fund this deal. So you have to understand that people in the finance industry, they make their money off of property, but they're in the money business, not the real estate business. So by them being in the money business, they're very cautious and careful about what they lend on. And that's the reason why they ask for a lot of documentations, proof of funds. You know, they want to know all the history pertaining to your life because they don't want to write a bad loan. They don't want to sell a bad loan. And most institutions sell their notes, their loans to the secondary markets, either through a hedge fund or private equity group or a big trust that buys notes and hold on to them because they make money off the yield of that note. So they can't afford to make costly mistakes because then that secondary investor can cut them off. Most lenders have what they call a credit line or warehouse line, where they're allowed to have a line of credit to do these deals, and that's the reason why they sell them off, to get that money back in order to reuse that money over and over again. So there's a lot of components tied into it that a lot of investors and buyers or borrowers don't know or don't understand, or if they do know, they don't know the whole process of it. And that's the reason why a lot of these big banks and even the community banks are very careful. There are banks that they carry their own note, which means that if they write the loan, they have it on their books because they're not attached to any secondary market that buys the notes from them. Whereas me, I have access to 300 different lending institutions and services that I can make deals happen because of my relationship with them by doing business with them in the past and in the present. And since I do have those type of relationships, there's a trust factor knowing that I can bring a good client or investor to the table that is credit worthy, has good net worth, and has experience in the industry of buying real estate, managing real estate, and analyzing real estate to know how to make money off that real estate. Because you have to have an idea and a plan on how to make money. You just don't buy the property and let it sit there and say, well, I'm going to make this money. You have to have a strategy in which to go by and put that strategy into place.
What about some loan programs? What kind of qualifications are needed, such as, say, what? What do you think? Multifamily?
Yeah, I mean, there's so many different areas and you know what I mean, that can be touched. So, I mean, we could really be here for hours talking about
we could be here
each.
for hours. So maybe just touch on under 5 units on multifamily, what you can do and what's needed as far as qualifications, and then maybe hotels.
Okay, so there's several different financial options, like from 1 to 4 units, that you can either go to through like a credit union or a community bank, or you have what they call non-QM, non-qualifying lenders that don't require more of the documentations. Your credit union and your community banks want full docs, meaning they want a lot of documentations in order to process the loan and to approve the loan. Your non-QM lenders don't have this many qualification. That's why it's called a non-QM, meaning non-qualifying loan. So those lenders are lenders that can get you in a loan program without a lot of documentations. There's some lenders out there that do non-QM. They don't ask for tax returns, which means you don't have to worry about them looking at your tax returns to see what you've made over the year or 2 years that you filed for taxes. In most cases, that lenders that ask for tax returns, they're not looking for the income that you've made. They're looking for whether or not you've paid taxes, because 99.9% lenders don't want the incumbency of having the IRS call them and say, look, we're putting a lien on this property because that particular taxpayer didn't pay taxes the last 2 or 3 years. They don't want that because they lose the money plus the property. And that's one of the reasons why credit unions and banks and institutionals that are regulated require taxes, where non-QM lenders don't require taxes. Then you've got asset-based lenders that make the loans based off the asset. It's not tied to anything you do personally. It's more or less, what is the value of the property? Does the property has enough revenue to generate to pay the debt that is covered on that particular property? Is the value good? How long has the property been operating at the level that it is? Those type of deals, asset-based, are a little bit more expensive because they're requiring less documentation and they're pushing them through quickly. So it all depends on whether a particular borrower is rate sensitive or if they're conscious about disclosing their taxes, and whether or not they want the best opportunity out there. I work with a lot of resources that they're requiring certain documentations, but they're also looking for good deals. And when I mean good deals, they want deals that are in good neighborhoods. Because no lender wants to have a property that's in a bad neighborhood, because that means that you have turnover in your rents. You can't maintain your rental base because people are moving in and out. And that's not good for you as an investor to have turnover like that, because it's more costly to you to keep bringing people in. Your people are leaving. It means you got to go in and clean up that vacancy and then turn it over and put it again. But if you don't have stability where people are staying in, you're spending more money than you are making. So lenders look for properties that are in good market areas, that is accessible to like shopping centers, grocery stores, near hospitals, maybe near an interstate or highway, where it's accessible where people can come and go and find it. That's another thing. It needs to be accessible where people can find the property to get back and forth. So that's why a lot of times deals don't go through because of that. And it's important to be able to know the market, meaning crime. Crime is a major deterrent when it comes to property, because if it's in a crime-infested area, then it means you have burglary, you have shootings, you got drugs, all that in there. And that has an impact on your opportunity to make money. And that also impacts what a lender might look at, because they say, well, where is this property located at? And if it's located in a bad location, then they don't want it, because, again, sometimes during the period of time that you own it, you might run across it where, you got people breaking in, burglary, vandalism, So they're very particular about properties they look at as far as to do loans.
So that affects the rate? Can you get it still done, or is it just a higher rate?
For example, if you brought somebody who got a property in a not good area, they're going to look at the numbers. The numbers don't lie. So if it doesn't generate enough money to cover with the debt, then they're going to require the investor to come in with more money. And they might even ask them to have more reserves in case of missing monthly payments. That's the whole point of having reserves, is to protect the investor's part of the loan. Where if, for example, the pandemic, a lot of people got hit because of the pandemic, because of what was going on. And so in order to protect their investment, they ask for maybe 6 months or 12 months reserves. That way they have a backup. If you can't make a payment that particular month, they got the reserves to cover that payment.
And can you talk to the agency loans you were mentioning to us in the past, Fannie, Freddie, for our multifamily guys, like the rates, how they work and the terms? I believe, you said a 10, 12, exact 30-year type of situation.
It depends on the property and depends on the strength of the investor. So, for example, let's say we have a real good, strong investor. He has an option of doing a 10-year fixed over 30 or a 12-year fixed over 30. The 12-year fixed over 30 is going to be more costly, which means the rate's going to be a little higher. For example, when we priced out the first time I priced out the 92, I got pricing for a 10-year and a 12-year. The 10-year was at that time was a 3.5 over for 10 years fixed over 30. And then the 12-year was a 3.74 fixed over 30. So the longer the fixed rate, the more expensive it is because of the risk factor. Agency loans and lenders mostly, the longer they have to hold that note, the more expensive it is to them, the more risk is involved. So that's why they raise the rate a little bit higher because of the risk factor. You've got Freddie Mac that has like a 35-year amortization on loans. And then if the property is not strong, then they're going to ask for either a 6 month reserve to make sure that the property is covered in case something happens. And now, since the pandemic has been involved, they're very picky about borrowers buying property. So if a person doesn't have experience in buying multifamily, they want them to have a partner who has experience in managing and owning multifamily property. On top of that, they want a good, strong property management company to be involved because they don't want someone to self-manage it itself, especially if they've never had experience in managing and owning multifamily property. They want a property management in there to offset the lack of experience that someone don't have. Because when you're talking about $2, $3, $4 million deals and higher, that's a lot of money to take a loss on when they do these loans. And they can't necessarily recoup the money all the time because of the fact that the cost of doing business may be a little bit more than which originally loan is. Because if you calculate, if someone lost their multifamily property, let's say a $3, $4 million property, it goes into foreclosure. Well, the foreclosure process is that they now have to go to court and file, which means they have to spend a filing fee to get the foreclosure process started. Then they got to bring in a property management company or say asset management company or a realtor to take over that property in order to help sell it, because lenders don't have license to sell their own property. That's the reason why a lot of times you have a property management company or asset management company in place to sell that asset for them. So they got to pay that expense on top of that. And then in most cases, a property is in foreclosure, you don't get the original price that you sold it for. You get a discount price because most investors are looking for a discount on a foreclosed property. So they're losing money on 3 different levels.
Correct.
And that's why they're more difficult and more time consuming to do, because they're going over paper back and forth. But the other part of that is that it's written twice. It's underwritten once by the lending institution, such as a bank or credit union, and then it's underwritten by the agency, either through Fannie or through Freddie Mac. So it's underwritten twice. They verify what the bank or whatever lending institution has underwritten that property for, and then they have their own guidelines that the bank has to follow in order to do the loan, because the lender is the bank, but Freddie and Fannie guarantees the loan. Same way we do with SBA. You do an SBA loan, there's 2 components. There's the lending institution, such as the bank, and then there's the agency that's guaranteeing a loan. So the agency that's guaranteed a loan, they're going to review all the documentations and paperwork that's submitted to the bank, and it has to meet up to their expectations and guidelines in order for them to do the loan. That's why it takes so long to do agency loans, because you got two institutions involved, not just one. You got 2, and that's what takes so long.
That's a good point.
And what is that time length? Is that 60 days, 65 days, 70?
It used to be between 60 to 90 days to do it.
Because I'm very impatient.
Huh?
I said, because I'm very impatient. I want the deal done now. Time kills deals.
There's parts of it that, okay, so with multifamily, you've got the appraisal, but then you got surveys. So then you gotta pay for surveys to get the survey done, which takes time because you have to order it, and they don't come out like right away. And if you're near something where you need environmental, now you got environmental. So you got appraisal, survey, environmental. All those reports have to be done and submitted in before the loan can even get close to being closed.
Yeah, I didn't even say that in the vlog the other day.
Yeah, it's so many. Yeah, you're right though. We've been down that road quite a bit.
I was telling production earlier. I'm like, we have to sell the buyer, pitch the buyer, then we have to sell the seller, then we have to, negotiate, and then it's the inspection, then negotiate again, and then appraisal. We have to sell the bank on doing the deal. There's more than just selling the property, like getting it under contract. It's not even a quarter of the way over,
That's
We've
true.
been a good part of our morning doing comps all over the place today.
Right.
Yeah, a couple hours minimum. We're still not even close to done.
Like I was on the phone with an appraiser yesterday, and I was helping him find comps because I know the area. So I sold something, and then I said, oh, well, you should also look at this. And he was like, oh my God, thank you. I would have missed that.
Yeah.
So, yeah. And then you do a lot of, you can do SBA, conventional, and USDA on, like you said, laundromats, I think, gas stations, and marinas.
RV, mobile home parks.
And RV and mobile home parks.
Yeah. So USDA and SBA loans are primary for owner occupied or owner user. And what I mean by that is, say, for example, you got a business like a restaurant. Okay, you can get a loan through SBA for those because you're owner, meaning that you manage and own more than 51% of the business. So anything that resolves where someone is managing and owning 51% of the business, those loans are more or less guideline to agency loans like this USDA, SBA, and what else is out there? There's those are loans for that you can get through if you have a business of your own that you're managing and owning more than 51%.
So like I listed a restaurant a couple days ago. So as long as they occupy owner occupant, boom, you can get them an SBA loan and for the proposed business and the real estate, correct?
Right. So there's several ways you can buy a business
Excellent.
that doesn't, to get an SBA that does not have real estate attached to it, but is more profitable and more secure to have a loan with an agency such as USDA and SBA where real estate is involved, because that means they're not going to look so much at all your asset, because when you do an agency loan, they're looking at everything. They're looking at your tax returns. They're looking at what you're spending. They're looking at everything. They want all kind of documentations, and that's another reason why it takes long, because they're combing through your whole personal and business life. Because again, they're the one that's going to guarantee the loan, so they want to make sure that all documentations is correct, everything is to the T, and that you have experience in whatever business that you're trying to get into or whatever type of transactions that you're trying to do. They want to make sure that you have experience, because they don't want you to get a $300,000-$400,000 loan with no experience, especially if you're talking about like hotels, restaurants, or any type of retail where you have to have experience in marketing. They want to know, okay, you got a hotel, so how do you market your hotel? When you got other hotels in the neighborhood, what is the avenue in which you're going to market to? What type of people are you marketing to? So they want to know your marketing strategy. And then they want to know What is your price point per door? Because if you got other hotels in there, you're competing. So how are you going to beat out those other hotels? How are you going to make money when you got hotel 2 blocks down, hotel 5 blocks this way, or 6 blocks that way? So you got 3 or 4 hotels around you. So it's not like you're just by yourself. You're competing against other hotels. So what's going to make your business, your hotel, stand out? Well, one of the things is marketing. Second thing is management. The type of management, how you manage your property, and the customer services that you offer. Because you have to be able to win the consumer over to the point where they'll keep coming back, but not only keep coming back, they'll start doing word of mouth and telling their friends and associates and family members they had a good stay, a great experience at your hotel, which means other people are going to want to come there and stay. So you have to have that type of customer service base that's going to make the consumer, your visitors, feel welcome, feel safe, feel appreciated, almost like a second home. And then the other aspect of it is your community. What community are you in? Are you involved in community activities where you got other businesses singing your praises? Yeah, that's a good hotel. Me and my wife, we had our anniversary there. We spent the weekend there. We had luncheon or something like that there. It's a great place. Well, now that spreads out into the community. So when new people come into town and they're looking for a good hotel, the community say, hey, you need to try Red Barns Inn. They're a real good hotel. Great place, great price is everything. And so that builds up your clientele base. It builds up your reputation in the community. And that goes long term over the course of time.
Yeah, that applies to any property and any business.
Yeah, definitely.
And that's the same way even with multifamily. If you got property management in place, they need to know how to be able to handle your tenants. You know, if you got an issue with a leaky faucet, okay, they write in a report, say, hey, I'm turning this in. I've got a leaky faucet. Can someone come and look at it? Well, yeah, we'll get to it and schedule a time. Go down and look at it. If it's something that can't be fixed right then and there, then try to project a timeline in which you're going to get a maintenance person in there or a repair person in there to go in and fix the problem. Because if you don't, now you created a problem because you got a tenant that's unhappy, and that can affect your rent. Because now they're going to say, okay, I'm not paying my rent on time. They didn't fix my water. They didn't fix my plumbing. So I'm not paying rent on time. I'm gonna do it. And then that spreads. And then
I think you mentioned to us in the past, basically, where, hey, okay, so you have not done this before. You're the borrower, but we can bring in like a national property manager that knows what they're doing, or a partner that has experience. So boom. Mm-hmm. And then we present them to the lender, correct? Excellent.
It's like, if, for example, if you or Sean is sick and you got to go to hospital to go to surgery, you don't want no brand new intern or just turned to doctor. You want somebody that knows your situation, that knows your diagnosis, and that can operate on you, because your life is on the line. So why would you put your life in the hand of a new doctor? You want somebody who's got experience of operating and has a successful rate in the procedures that you're going to go through.
So how can we get a hold of you? Do you have any of your social media stuff that we can, if you want to announce your website or LinkedIn or Instagram or anything?
I'm on LinkedIn for one. I'm also on Facebook for another. I do have a website, but I just took it down. I'm in the midst of redoing it. But you can reach me at LinkedIn. You can reach me on Facebook under Hills Financial Services.
And we'll put those.
And of course, for us too. You can always, anyone out there needs to go.
Yeah, they can reach us, or we can put the link down below, or reach out to us, everyone. And so that's just to sum up. Any words, Mr. Sedita?
No, thank you so much, David. Again, we hope everyone out there listening is, got a little something out of this. And again, any more questions you guys may have, or anything, like I said, we can look David up on social media. He's working on getting the revamp of the website. And then again, please contact Dino and myself, and we'd be more than happy to put you in touch with David Hills.
And don't forget to like, subscribe, and share. And thank you, David, and thank you, everyone, for being a part of the Deal Room, episode 10.